Jobs data coming in strong. Equities down, yields up. Live from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, coming up, the latest jobs data coming in hot. Janet Yellen touching down in Beijing, and Instagram taking on Twitter. We begin with the big issue, payrolls, up next.
We're looking for another big print on Friday.
The June payroll report.
Payrolls.
The jobs data.
We're going to see a strong jobs report.
We expect the consensus.
Payroll data are suggesting that things are very tight.
Labor markets are tight.
Labor market has been really strong.
Robust strength.
It's been rock solid. We really need to see the job market start to crack.
We haven't seen anything crack yet.
That's what everybody will be looking for.
The payroll report has beaten 14 consecutive months.
We're still worried that the Fed needs to do more.
Unless we get a surprise to the downside, they are moving ahead with one or two more hikes.
That might be the game changer.
That employment picture is probably the linchpin that we're all looking for.
Joining us now to discuss, Lafayette's Krishna Mamani, Mike Kontopoulos of RB Advisors. Gents, great to get your reaction to that data 30 minutes ago. Krishna, first to you. Should I care about the ADP report?
Well, ADP report certainly foretells the potential strength that we are going to see tomorrow. I think the bottom line is very simple. That is, the labor market remains extraordinarily strong. The U.S. economy is actually has the chances of re-accelerating rather than slowing down meaningfully. And the unfortunate part in all of this is that has been discounted in the market already. So that makes the bond market extraordinarily vulnerable.
Bond market's in a big move this morning, that's for sure. Bonds down, yields up in a big way. 2-year through 5%. Actually taking out the highs for the year at one point. The 2-year at the moment at 5.06%. The 10-year through 4%. The 10-year up by 9 basis points. The 2-year up by 12. Look at that data, Mike, this morning. ADP, 497,000. 225K. The estimate. That's a blowout report, a massive upside surprise. Mike, how much weight should I put on 497,000 from ADP?
Well, Jonathan, you can't discount it for sure. I mean, listen, it's a red hot, if not a white hot labor market, which is a bit surprising given what the Fed has already done. And, this cycle sure seems to be a bit long in the tooth at this particular point. I think I disagree with Krishna a little bit. I don't see a lot of reason for re-acceleration of the economy here, but clearly it's not slowing down to the extent that you would think 500 plus basis points of hikes would ultimately achieve. And so I think, listen, you have to, pay attention to the data, and the data is clear. Labor market is hot, and I think at the end of the day, this is going to be a big concern for the Fed, and they're going to have to continue to hike until they break labor. Labor is the key, and so. Yeah, you can't discount this one bit.
Most people anticipate another one in a couple of weeks' time, hence why we're seeing a 2-year through 5%. You talked about the broader data here, Krishna. If you look at the surprise indicators, we've been talking about them, upside surprise after upside surprise. That index is the highest since 2021. And one thing I've been asking of guests, and Krishna, I'll ask you as well, is it because the data is just better than expected, or is this economy improving?
Well, so I think the data is certainly better than expected, but I would say that the economy is actually improving, if not improving, at least holding on to the strength that it had coming into the second quarter. And there is basically no sign of slowdown whatsoever, especially in sectors that are traditionally interest rate sensitive. And if the Fed's 500 basis point rate rise is going to have a meaningful impact, it has to show up somewhere. And so far, it hasn't shown up anywhere in terms of investments, in terms of housing, in terms of construction. I think if there is a kind of a silver lining in terms of a potential slowdown, it's probably consumption to some extent. And hopefully that kind of drives the normalization of growth. And that's what, as a soft landing proponent, that's what I'm hanging on to.
Sit tight. I want to bring Mike McKee into the conversation. Michael McKee, a blowout jobs report 34 minutes ago.
Yeah, everybody's saying how hot it was. I feel like Ed McMahon with Johnny Carson. How hot was it, Johnny?
497,000. That's 500,000 jobs. And most analysts right now are kind of dismissing that, saying it's out of left field. Omar Sharif saying it doesn't relate to anything we've seen on this planet. But it is a data point that we want to look at. Jobless claims probably getting more attention in the sense that at least we have something in the range of what we've normally seen. And they're continuing claims maybe telling the story because they fall. That's the number of people who are actually getting benefits, not just filing. And if that's falling, it doesn't suggest problems in the labor market. The June's jobs forecast not changed yet. 225 is the number so far for tomorrow. We'll see when we go into the report at 8:30 in the morning. Speaking of ADP, I wanted to show this chart here because ADP has been coming in, this is all private sector jobs, lower for the most part for the last year or so than the non-farm payrolls private sector jobs. And look at how high ADP is in comparison to anything else. If we were to get something like that in payrolls, you would have quite the bond market reaction. I can tell you that. And then just in from the Federal Reserve, John, Lori Logan, the Dallas Fed president, is a voter. She's out with a speech this morning saying we need to raise rates more. She was one of the people in the minutes who said she wanted to raise rates in June. She says the continuing outlook for above target inflation and a stronger than expected labor market calls for more restrictive monetary policy. So she's the first one out. Next week we get Daly, Mester, Bostic, Barkin, Kashkari. A lot of Fed speak, and it's going to be very interesting in the wake of all these employment numbers to see what they have to say.
Mike McKee, you did the hard work yesterday. You read through those minutes. I found them somewhat confusing. Go through them for me. How splintered is that Federal Reserve right now?
They are definitely have a division there because several members wanted to raise rates. That's more than two. So you do have a contingent at the Fed who thinks that they're going to have to do more and should have done more, which means that there is a strong likelihood, given what everybody has said, that we're locked in now pretty much on a July rate move. And the question we'll get out of maybe tomorrow's numbers is how locked in are we going to be on September?
Still got some PMIs coming up in the next hour. Mike McKee will touch base with you in just a moment. Michael Kontopoulos, I want to talk to you about the recession call. The recession call, which just seems to be pushed out and pushed out and pushed out and pushed out continuously. Is the second half too soon to make a recession call based on the information we're looking at this morning?
It sure seems like it is. You know, there's an irony to this, Jonathan. We've spoken about it before, which is that the stronger the data comes in, the more aggressive the Fed ultimately needs to be. And that increases the probability of a hard landing. Now, when that ultimately occurs, whether it's later this year, in the first half of next year, in the second half of next year, we can't be sure. Clearly, the data, to Krishna's point, is surprising to the upside. But what I worry about is the stresses that we're seeing in the weakest parts of the credit market. And as I look at things like repeat filers or small private companies, when I look at the amount of distressed companies out there, the fact that the floating rate sub-investment grade part of the market is now nearly $3 trillion between private credit and the leveraged loan market. You've got some real potential stress coming from higher interest payments that these companies are going to have to incur, and ultimately likely layoffs and a lack of investment in CapEx in order to continue as going concerns. And so when does that happen? Does it happen in the second half of this year? I mean, anything's possible, but it doesn't look like that's going to be the case. But certainly, I think at some point, you will see something break here. And I think it's going to come from the credit markets, quite frankly.
Well, we saw it break several months ago. We had bank failures, and we've moved on pretty quickly since then. Michael, you made the connection there between a market problem, potentially, and an economic impact. Do you think that is a market issue, or is that a broader economic problem on the horizon?
I actually think it's going to be both. It could be a market issue and a broader economic issue. I mean, listen, look, what's happened so far this year, right? It's been really an environment where certainly, you've had risk run because of, data that surprised the upside. But let's be frank, you've had a huge increase in tech, comm services, discretionary on the back of expectations for the Fed cutting and an AI mania. That can easily go away if the Fed's going to hike another 25, 50, 75, or 100 basis points. And then you've got the underlying stress in the credit markets really kind of denting the economic outlook. Again, maybe 6 months out, maybe 9 months out, we don't know. So I think it's both. You could really see a big unraveling of everything we've seen so far this year, wider credit spreads, a broader economic impact. But it doesn't, I mean, listen, I don't want to be too dire here. I mean, it doesn't feel like this is going to be the case in the next 3 months or maybe even the next 6 months. And so there's certainly a lag, and I wouldn't be too quick to say it's imminent.
Well, let's be clear. That's not what's been developing, and you're acknowledging that right now. The S&P 500, double-digit gains year to date, high-yield spreads, tight, south of 400 basis points. Credit to you, Krishna. A lot of people have struggled with this equity market. You've said repeatedly, continuously through this year, upside risk to equities. That could be the pain trade. That's been the pain trade, Krishna, for so many people. Krishna, away from equities now, what do you think the pain trade is?
I think the pain trade really is in the bond market. That is, the economy has to start slowing down somewhat. Labor markets have to soften. And if that doesn't happen, then the Fed has to make a decision as to how are they going to tackle this challenge. One option is to continue to raise Fed funds rates to 6%. Now they can certainly do that, but I think if they start going down that path too hard, then it creates a problem in the banking sector. So I think the more likely outcome is they probably raise it to 5.5%, somewhere less than 6% anyway, and just hold it for a lot longer than what the markets are anticipating. And if that ends up being the accepted thesis in the market, I have difficulty understanding how 10-year at 4% ends up being the end point of a pain trade.
Well, that's what I want to build on. 2-year, that's easy stuff. If we expect more hikes, ultimately you get a higher 2-year yield, 5% plus. New cycle highs right now. Earlier on this morning, 511.76. I want the 10-year call from you, Krishna. 4% right now. Have we seen a cycle high? Where do you think that high is?
No, I think 4.5 at the current pace anyway. 4.5 is probably more likely the cycle high than 4%. The real action, as you said, is really in the 10-year. The 2-year is going to move, is really more Fed funds determined. 4% is really more about longer-term policy outlook from the Fed, whether they hold a high Fed funds level for a really long period of time, and that is what is looking very likely at the moment. I think on the 10-year front, one of the things why the 10-year has held down as well as it has is because of inflation expectations remaining somewhat anchored, not somewhat anchored, very well anchored. But that doesn't mean real rates cannot go up. And I think that's where the pain trade will manifest itself.
Mike, you get the final word on this one. On a 10-year, what's your stance now?
I mean, listen, I think it'll be tough to break through the fall highs of 4.35. I mean, that was really driven based on, some boneheaded moves by, what was going on in England in terms of tax cuts and high inflation, and of course the Bank of Japan defending the currency. And I don't see, unless you get something like that again, I don't think the 10-year is going to go appreciably higher than where we were in the fall. I mean, Krishna's absolutely right? The long end of the yield curve is a representation of future growth and inflation expectations. And if the Fed can remain, credible and bring down inflation and growth expectations, then the 10-year shouldn't go up that much higher. And if they fail to bring down inflation expectations or anchor them as they have so far, if they were to kind of get unhinged, then certainly you have higher to go. I think I have a lot of faith in the Fed's ability to be able to bring down growth and bring down inflation. And so, I think we've probably seen the highs, but at this point, it's anybody's guess. But I think, Jonathan, what the last thing I will just say is, at the end of the day, to me, what matters is the end game. The path to get to that end game, it might be a little bit unclear and uncertain, but the end game is likely lower because I just don't see how we get inflation to 2% without really denting labor and without causing a hard landing. And so I see much lower 10-year yields as the ultimate destination, but who knows what happens between now and then.
Mike, Krishna, to the both of you, thank you. What a 44 minutes we've just seen. 44 minutes ago, no one cared about the ADP report, and then 1 minute after that, all of a sudden people care about the ADP report. Often that's how it goes. 497,000 the number. That's the print, the expectation, the estimate 225, the runway through this morning. We move on to a PMI that comes out a little bit later this hour. ISM services coming out too. We get jobs, job openings, All of that good stuff onto payrolls tomorrow. Yields are flying through 5% on 2s, through 4% on 10s. Let's get you some movers. Here's Abby.
John, let's keep it super simple. And on that super hot ADP report and those yields flying higher, big tech is down. In fact, Apple right now in the pre-market is set to open back below the $3 trillion mark. The price to watch is $190.73. Right now on pace for its third down day in a row, the longest losing streak potentially for Apple going back to, and actually we don't have Apple on this board, but Tesla is also lower, representation of big tech being lower, down 1.6%. On the other hand, Meta still getting a little bit of a boost from its competition to Twitter. And big tech overall, John, it's down as yields are in fact higher.
Abby, thank you. We'll stay on tech. Coming up on the program, Mark Zuckerberg's Meta taking on Elon Musk's Twitter.
If you look at anything that's tried to challenge Twitter in terms of any of the other platforms, it's been very difficult to scale. The question is, how much resources are they going to put into this? And is this just sort of a moonshot type project or something that they really want to scale?
That conversation up next.
The question is, how much resources are they going to put into this? And is this just sort of a moonshot type project or something that they really want to scale? And look, I think for Zuckerberg, they went from a position of massive weakness, going back to, when you talk about 8-9 months ago, to now it's a flex the muscles moment. Monetizing has obviously been key. Ultimately, that's been the issue for Twitter. That's been the uphill battle.
It is Zuck versus Musk as Meta launches its new Threads app. The platform designed as a direct rival to Twitter, collecting more than 10 million sign-ups within the first 7 hours. The CEO, Mark Zuckerberg, celebrating the debut with his first tweet in 11 years, taking a playful jab at Elon Musk. Musk responding shortly after tweeting, quote, "It's infinitely preferable to be attacked by strangers on Twitter than indulge in the false happiness of hide the pain Instagram." Let's bring in the Bloomberg team. Ed Ludlow on the West Coast, Mandeep Singh here in New York, Alex Webb over in London. Ed, I have to say, you've looked at it, I've looked at it, we're both on it. Looks a lot like Twitter, doesn't it?
Looked at it, I spent hours on it. It was the most strange afternoon of my life, to be honest. But that was what was happening. 10 million's the latest figure, it's probably higher by now. And lots of people acknowledged straight away on the platform it is the same. That is the meme that Zuckerberg tweeted, right? It's a reference to episode 19B of the 1967 Spider-Man called Double Identity, basically saying, there it is, good timing, Mr. Director. It's the same thing. And a lot of people acknowledge it. That said, from a technology perspective, John, I've been engaging with a lot of market analysts, a lot of users as well. They point out there are some UX differences that they don't like about Threads, that they do like about Twitter. But the pace of adoption, that's what was really interesting to me Wednesday afternoon.
10 million, 7 hours. Mandeep, what is critical mass? How big do you think that needs to be and how quickly?
I mean, look, as you said, right now everyone is trying to grab their handles. But to me, the key is, the feed and the algorithm that goes into driving engagement. And time and again, we have seen anytime you change the algorithm on Twitter, people start to complain. And look, they have amassed an interest graph over the last 15 years. It's hard to bring in that interest and follower graph on Threads overnight, even though Instagram has a great, stack and they can leverage a lot of the user data they currently have, but it still won't be able to replicate that Twitter interest follower graph. And to me, the algorithm is the key. That's what TikTok did with their video platform. That's what Meta needs to do with Thread algorithm in terms of how they curate the feed.
Alex, this effort clearly accelerated. Any idea where this leaves leadership over at Twitter in their next move?
And I'm sure we'll see the sort of fairly characteristic Elon Musk braggadocio saying everything's fine, no need to worry. The likelihood of things changing anyway with the new leadership, Linda Yaccarino coming in, trying to forge closer relationships with advertisers, many of whom have left the Twitter platform. I think the key thing, as sort of Mandeep partially alludes to, is like, do you lose the power users, the people who generate a huge amount of the content disproportionately to the number of users they are? even if there's only 10, maybe 20 million at this stage users over on Threads, are they those people? And therefore you're losing the stuff that drives a lot of your engagement, and by extension then losing the advertisers. Those are the people they really need to keep. And they seem to, at least judging by the current evidence, like old Twitter. If you've got your head screwed on, maybe you think about, well, do we need to be more like old Twitter?
Alex, how seriously do you think creditors will be taking this morning after that unveiling yesterday evening? Creditors to Twitter, to Elon Musk specifically.
I mean, I wonder whether actually anything has changed, because things already seem pretty dire over at Twitter. This seems to be another piece of bad news rather than necessarily being the nail in the coffin. There's probably a certain amount of panic. We saw Fidelity writing down the value of their stake in, or their investment in Twitter by, 3/4 in May. That's already considerably bad news for people who have helped Elon Musk buy the business.
Mandeep, Twitter was never a great business, regardless of who ran Twitter. And I'm wondering, Mandeep, if this is ultimately something that Meta can achieve themselves in-house. Is this a business you want to try and build out?
I think for Meta, it's an engagement play. Right now, their top line growth is not going to come from adding more users. They already have 3 billion users across their family of apps. It's going to come from driving engagement. And they did that with Reels. If they can add another dimension in terms of real-time conversations, politics, news, etc., with Twitter, that'll be huge, not only for the incremental ad dollars, but also the large language model that they're trying to develop, the proprietary data that they have around users and their interests. I think this will be huge.
Mandeep, we're going to stay on top of the story with you, sir. Thank you. Mandeep Singh with Alex Webb. To the both of you, thank you. Ed, I know we're going to touch base around the opening bell in about 7 or 8 minutes' time. Looking forward to doing so. Your equity market right now, negative 0.9% on the S&P 500, about 7 or 8 minutes away from the opening bell. About an hour ago, if you are just tuning in, you missed this one, a blowout. Upside surprise on the ADP report. A jobs report here in America coming in hot, just south of 500,000, 497K, the estimate 225. That just in front of payrolls tomorrow morning. That sent equities down, yields absolutely flying. The 2-year yield is up by 13 basis points at the moment at 5.07%. The 10-year is up by 11 to just north of 4. Coming up, the morning calls, and then more on that move in this equity market with Amy Wu Silverman of RBC. From New York, this is Bloomberg. Seconds or so away from the opening bell. Let's whip through the price action for you. Equity futures negative 0.9% on the S&P. On the Nasdaq, we're down by a little more than 1%. The main event, the last hour or so, it's all about the ADP report coming in much hotter than anticipated, driving equities down and yields much higher. There's the opening bell. Switch on the board and get to the bond market. The bond market looks like this. Treasuries down, yields up and away. Up by 9 basis points on a 10-year through 4%, 4.0271% on a 10-year this morning. Dollar not showing much strength off the back of that move. The euro just south of 109 at 108.85. We're positive on that currency pair by 0.3%. And to round things out in the commodity market, down by 0.4%. No drama there. $71 and about 50 cents. Let's get to one sector to watch at the open. The airlines. JetBlue terminating its joint venture with American following a judge's ruling against the partnership, writing, quote, JetBlue has made the difficult decision not to appeal the court's determination, beginning a wind-down process that will take place over the coming months. The airline now shifting to focus on completing a $3.8 billion acquisition of Spirit Airlines. Kelly Lyons joins us in D.C. for more. Hey, Kaylee.
Hey, John, this literally seems to be a matter of picking battles because, as you said, you did have that federal court ruling that its Northeast alliance with American Airlines violated antitrust laws. That was one legal fight they had underway, the other being the challenge to that $3.8 billion merger with Spirit, which JetBlue says it needs in order to scale and compete with the carriers that dominate in the U.S. market. But the U.S. has concerns about market concentration in certain cities that could give that company, a merged company, pricing and competitive advantage. So JetBlue deciding to focus on saving that deal, going to wind down that alliance with American, which is why you are seeing JetBlue and American shares lower in the first few minutes of trading here, each down about 2%, whereas Spirit Airlines, the ticker there, SAVE, on the idea that this may help the odds of that merger actually going through, is up by about 1.6%. I would note that JetBlue CEO Robin Hayes did say in a statement that he's hoping that taking the DOJ's, quote, misplaced concerns about this partnership off the table could help, though, when they go to trial this fall, actually obtain Spirit Airlines. That trial is set to begin on October 16th, John, so we'll all have to eagerly await that result.
Kelly, thanks for that. JetBlue down about 2%, American down by 1.5%, Spirit up by 1.9%. About 2 minutes into the session, we are down by 1% on the Nasdaq. On the S&P, we're down by 0.9%. Much of this off the back of this move in the bond market, off the back of the ADP report about an hour ago. We're going to get some more data in the next 30 minutes. PMI and services, the ISM just around the corner. Job openings as well, so looking forward to all of that. I want to turn to energy. Shares of Exxon under pressure after saying lower nat gas prices and refining margins should reduce its Q2 results by roughly $4 billion. Analysts at RBC Capital weighing in, writing this. The update is likely to be viewed negatively for earnings expectations, and we expect consensus numbers to move lower over the coming days. Abby has more. Hey, Abby.
Hey, John. Yeah, this is not good, and this suggests that the earnings season that we're moving into now could be under some pressure. This is the first big pre-announcement that I'm aware of with this company, basically lowering the guidance below what the street was looking for. They are saying that the lower natural gas prices and the refining margins are going to reduce the second quarter earnings. If you recall, well, actually, you were away. You missed this one, but General Mills, their outlook was not great because consumers are finally not willing to pay up for their brand prices. So totally two different sectors. But I think that the big takeaway here from this Exxon this pre-announcement, is the idea, again, that this earnings season that's coming up could be a little bit challenged. And analysts are across the street somewhat neutral here, basically saying that this guidance that they provided was a bearish miss.
Abby, thank you. Stock down 1.5%. Broader equity market near session low, still falling, down about 1% on the S&P 500 right now. Keeping an eye on that. Also keeping an eye on the automakers, Tesla and China's top EV makers signaling a truce to their price war, with top executives pledging to, quote, adhere to industry rules and regulations, regulate marketing activities, maintain fair competition, and not disrupt fair competition with abnormal pricing. David Welsh, the Bloomberg Detroit bureau chief, joins us now for more. David, is that the price war over?
It was already starting to abate even before this. I think maybe they had all pushed each other until they collectively cried uncle. But look, I think once they go public with this, and they were probably nudged strongly by the government to cut it out, I think probably it is. You may see some adjustments here and there, but yeah, I think they probably will. It's kind of a strangely worded agreement if you look at it. One of the things was promote core socialist values, I think. And they were very careful not to make it sound like price fixing. But I think there is kind of, a collective will to say, all right, let's kind of normalize things if we can. And consumers were very upset about some of these price cuts, too, if they had paid more weeks before.
Yeah, you do wonder how much certainty you'd have going out to buy a car, and wondering whether in a couple of weeks' time it's going to be much, much cheaper. David, thanks for that. David Welch there of Bloomberg on the latest. Big implications for Tesla, of course, and maybe some good news for Elon Musk. Some not so good news for Elon Musk, with shares of Meta getting a boost at the opening bell. Instagram officially launching its new Threads platform, an app designed as a direct rival to Twitter. The CEO, Mark Zuckerberg, posting his first message on Threads, writing, I think there should be a public conversations app with 1 billion plus people on it. Twitter has had the opportunity to do this, but it hasn't nailed it. Ed Ludlow joins us now for more again. Ed, question, I guess, is whether Meta, Instagram, Threads can nail it.
Yeah, there was a lot of enthusiasm at the open. We were up more than 1% on Meta, now down actually flat on the stock. So it was a pretty short-lived higher open. Bernstein has a note out, John, posing this question, whether they could ever achieve critical mass to make it a competitor to Twitter. KeyBank Capital Markets has actually raised its price target to $335 from $280. They see in the near term Threads being an immaterial contributor to Meta's financials, but longer term do pose the question what kind of ad streams it could bring in. That Zuckerberg comment about a platform with 1 billion users and Twitter's failure to achieve that scale, that was kind of the most interesting development to me in the last 24 hours. A fun fact, John, that if you consider all of the user base of Meta's other properties, Facebook, Instagram, and WhatsApp, they would only have to onboard 1 in 10 of each of those users to the Threads platform to eclipse what Twitter was able to do with its registered monthly active user base. 1 in 10 to transfer and outdo what Twitter's done. So I find that to be very interesting. a lot of energy on the platform. I know you've played with it. TK he followed me in the last hour, a remarkable development. But I think a lot of users do have questions about what this becomes. No ads on the platform currently as an example.
Well, give it time. You'll see plenty of ads, no doubt. Ed, thank you. TK, very distracted by Threads this morning, as you might be able to tell based on the programme we delivered a little bit earlier on. Your equity market more broadly is negative by 1% on the S&P 500. I want to stay on big tech just for one further note. Morgan Stanley expected Microsoft to eventually join Apple with a $3 trillion market cap. They wrote this: generative AI looks to significantly expand the scope of business processes able to be automated by software. Microsoft stands best positioned, they think, to monetize that expansion, which, accompanied with a still reasonable valuation, makes Microsoft their top pick in large cap software. Broader market, as I say, is negative this morning. We're down 1%. Yields are a whole lot higher by 9 basis points at the very front end, just shifting away from session highs. Still north of 5% though on 2s, on 10s north of 4% and up 9 basis points today. Amy Will-Silverman of RBC with this to say: post the holiday, we could see volatility perk up again as we head into earnings season. Amy, I'm pleased to say, joins us now. Amy, can we build on that? Why you expect volatility potentially to pick up?
Sure. Look, we were obviously last week in the midst of the summer doldrums with the July 4th holiday. But, as we head into earnings season, this historically is a time, in particular in the first 2 weeks, where you see volatility buying. And we really have had volatility just absolutely pummeled, John. Data like today perhaps changes it a little, but we've just had really suppressed levels and folks keep selling it even further.
It's amazing to have this backdrop. At the same time, maybe we've had narratives all over the place. We've gone from soft landing, no landing, hard landing, back again. And yet, as you've pointed out, volatility's remained pretty low. And the question I know you're grappling with, and you're hearing this question from clients, is whether we should be selling low volatility. How do you think we should express that? Through single names at the index level? What should we do?
Yeah, it's a really interesting question, and it all comes down to the math, because as we all know, it's been very narrow breadth. Even today, you guys were talking about Threads earlier in Meta. The first thing that comes to my mind as a derivative strategist is, well, where is Meta the biggest, chunkiest weight? It's actually XLC, the communications spider ETF. And so you see that interplay. So is it better to own volatility in Meta, or is it actually better to own volatility in XLC? Because one is such a huge proportion of the other that you would expect them almost be proxies at this point. And you see that in the market too. So, one thing we've said is, if you're looking to hedge, Apple volatility might actually be a good proxy for S&P volatility, given how much of a weight it has become and how low it is in that particular single stock relative to the index level.
Just to recap the price action right now, down 1% across the board. Pretty much on the S&P, we're down 1%. On the Nasdaq, we're down about 1% plus. Similar move on a Russell on the small caps. Amy, I want to pick up on what's been happening with the bond market and what it hasn't done to the equity market so far year to date. If I told you earlier this year where yields would be, where Fed funds would be, where Fed communications would be, I could give you really precise detail on all of that. Would have it helped you make a move in the equity market, put money in the right places, given what tech's done so far year to date?
It's astonishing. I would have liked to say yes, but I don't know that that's the truth. So, we usually think of the rates market as leading, and, people like to look at rates volatility on a cross-asset basis relative to equity volatility. That ratio just hasn't worked out this year. It's almost been the other way around, and part of it does have to do with that Magnificent Seven really leading the equity market. And this is why, one thing we've been talking about is this could just be a tale of two narratives. I think the market is fixated on the idea of rotation. What if we just get tech continuing a rally because of the AI story, because of stories like Threads? We also get an economic breadth widening at the same time. If that happens, that would tell you that we still lean to be more of a market that's bullish than bearish.
Would that be your base case?
Yeah, look, when I think about that question, I always think about how it's positioned in the market right now for options. And I can tell you there's very little demand for hedging. I can tell you, even with volatility at these levels, people are still continuing to sell it. And of course, that can beget something like 2018, where we had a Volmageddon, but can also continue when you look to history. It's not clear that one always leads to a burst of volatility, especially when you have the case of such narrow breadth continuing to drive that positive momentum.
Big moves this morning, that's for sure. Amy, thank you. Amy Silverman there of RBC on the latest moves. As I've said repeatedly, about an hour or so ago, an hour and 10 minutes ago, big economic data print here stateside, an ADP report that many people will tell you they don't care about. And then, of course, all of a sudden they care about it. ADP comes in hot. Jobs look very good. Yields start flying. Equities start dropping. We're down 1% on the S&P. On the Nasdaq, we're down by more than that. On a 2-year, back through 5%. On a 10-year, back through 4%. Not translating into dollar strength in a major way. In fact, some dollar weakness against the euro today at 108.81. Some more economic data coming up just ahead of Friday's payrolls report.
The idea of slowing down the pace of rate increases and continuing to slow the pace of rate increases makes sense.
The PMI data up next.
The idea of slowing down the pace of rate increases and continuing to slow the pace of rate increases makes sense. Getting some more data, getting some more information about how the economy is performing, how the past effects of monetary policy are affecting economic activity and inflation, and then basically having a meeting by meeting decision about how to adjust policy.
More economic data just moments ago. Let's get you some of that with Mike McKee. Hey, Mike.
Hey, John. Well, we're getting the S&P version of services PMIs, and they come in stronger than anticipated. 54.4 up from 54.1, and the composite at 53.2 is a little bit higher than the 53 that we saw in the preliminary numbers for June. Now we get the ISM services numbers top of the hour. They're expected to rise a little bit as well. So we'll see if S&P is any kind of precursor to that, but it does suggest there's still some strength on the services side, John.
Mike McKee, it's pretty phenomenal, isn't it? The distinction that you can make between services right now and manufacturing.
Well, Americans spend more money on services, and it's a service economy. So it really matters what's happening there. And the hard part has been deciphering what's happening there because of the jobs picture and the fact that they've had trouble hiring people for many of those jobs, at least until we saw ADP today.
Mike, does one necessarily have to converge to the other? Can this persist?
It can persist. As, we don't have a rule on this. We passed goods with services some time ago, and so we'll probably continue to see services be the strength of the economy, although we're spending a lot more money now to try to build up the manufacturing sector in the United States. So we could converge. We could see something like that happen. Amazing.
Mike McKee, thank you. Just another strong data print relative to expectations. We've seen that repeatedly. We've mentioned this repeatedly too, that economic data relative to expectations, that index, the surprise index, the highest since 2021. Strong data early this morning, but I guess good news, bad news. I know you hate that stuff, I do too, but that's the reality in front of us at the moment, at least. We're down 1% on the S&P 500. Some data earlier this week. Weak manufacturing in China, we know that story. Weak services data as well, something to keep an eye on. And with regards to China, keep an eye on this as well. Secretary Yellen touching down in Beijing, preparing to meet with Chinese officials for economic talks as trade tensions continue to simmer. Kaylee Lyons back with us with more. Hey, Kaylee.
Hey, John. Yes, she's officially there, but her first formal engagement won't be until tomorrow, Friday, where she is set to meet with the premier of China, Li Qiang. She'll be meeting with other senior government officials as well over the course of this visit, which does go through July 9th. But as for what tangible may come out of it, the bar does seem to be set pretty low. The Treasury Secretary, of course, has been expressing her desire to make this trip for months now, but really this is just about opening lines of communication. She is likely to raise issues around trade, around debt relief for distressed countries, issues like climate change as well. But it doesn't seem that we're expecting any major breakthroughs or real deliverables coming out of this meeting. This is really just a victory for the administration in that they are talking. This, of course, follows Secretary of State Antony Blinken, who made his own visit to Beijing last month, and Bloomberg reporting today that after Yellen's visit, climate envoy John Kerry is expected to make his own trip to Beijing to address the climate change issue. But the backdrop here is very, very tough, John. Obviously, There has been a bit of a tit for tat when it comes to the fighting around trade and economically sensitive issues. China, just days before Treasury Secretary Yellen arrived, put export curbs on two very strategically important metals, gallium and germanium, where the U.S. is considering imposing restrictions on China's access to cloud computing. Plus, you have the defense concerns as well. Chinese President Xi Jinping was giving a speech earlier today talking to the military forces around Taiwan, asking them to strengthen drills and boost its capacity to win wars. So geopolitically and economically, very difficult backdrop for the Treasury Secretary as she starts these conversations. John.
Kelly, what's your take on this? Does this set the stage for a leaders' summit later this year? What are you hearing about that?
Well, that's a very difficult question because obviously after Secretary of State Blinken's visit last month, there was optimism that it could set the stage for President Biden to meet with his Chinese counterpart potentially at the summit later this fall. Then just very shortly after, you, of course, had the dictator comment that President Biden made at a donor event, which China reacted very negatively to. So it's just a question of whether or not the Chinese president may be open to meeting with the president in person. But Biden has continually expressed his hope that a meeting will be taking place in the coming months.
Blinken, now Yellen, as you indicate, Kerry next, and potentially a leaders' summit coming up too. Kelly Lyons on the latest there. What to watch over the next couple of days, as we say, as trade tensions simmer, the tit for tat, back and forth between China and the United States continues. For the broader market, if you are just tuning in, welcome to the program. 20 minutes into the session, equities down by 1% on the S&P. On the Nasdaq, down by a little more than 1%. The data decent, way better than expected on the ADP report. Jobless claims doing okay. In about 10 minutes from now, you'll get a read on ISM services and job openings too. That's really important stuff, particularly with where yields are right now going into it, with a 2-year up by 10 or 11 basis points through 5%, a 10-year through 4%. Let's get you some sector price action. Here's Abby.
Yeah, and that yield story, John, is really influencing the sector composition. Not surprisingly, with the S&P 500 heading to its worst day since the end of May. We're looking at all 11 sectors lower. Now, super interesting. Real estate is the worst sector, down 1.8%. That, of course, is because as yields go higher, those dividends on the real estate stocks look less attractive. Consumer discretionary down quite a bit, with Tesla being down. Energy, utilities, another dividend-sensitive sector. Tech right in the middle of the pack, down about 0.9%. Consumer staples, which is defense, down the least, down 0.4%. Let's dig in a little bit deeper, though, to tech, because Apple is still below that $3 trillion mark. So tech is down about 0.9%. Apple off of its lows, nonetheless, down for a third day in a row. The stocks over the last 2 days, John, down 3.7%, thereabouts, the worst since the end of April. Qualcomm and Apple suppliers. So this is all very interesting on that hot ADP report ahead of tomorrow's jobs report.
Monster upside surprise there. Abby, thanks for that. Ahead of payrolls tomorrow, 225 is the estimate. You wonder if that starts to bleed a little bit higher as more estimates come into our Bloomberg survey over the next 24 hours or so. The previous number, of course, 339,000. Payrolls, 225. That's the median estimate in our survey. 170 is the estimate from Citi. Andrew Hollenhorst caught up with us a little bit earlier on. He's looking for a softer jobs report of 170, but ultimately other data, as we can see this morning, not showing much loosening in the labour market. And Citi's Andrew Hollenhorst looking for another hike in July and another hike in September. And based on the minutes we got yesterday from the Federal Reserve and the communication we've had from Chairman Powell, and from the New York Fed President John Williams too, it looks like July, later this month, we're going to get another hike from this Federal Reserve. Coming up next, your trading diary, the runway into the weekend and into payrolls tomorrow morning. 25 minutes into the session, equities down for a second day by 1% on the S&P. On the Nasdaq right now, down by 1.4%. Some real weakness in the equity market off the back of better economic data, sending yields up and stocks down. About 25 minutes into the session, that's the price action. Let's get to the trading diary. Coming up a little bit later, about 5 minutes from now, JOLTS data, job openings in America, and ISM services information as well. Another read on the service sector just around the corner. President Biden delivers remarks on the economy at 1 p.m. Eastern time. Look out for that. We round out the week with the US payrolls report tomorrow morning. And looking ahead to next week, another busy slate of Fed speak and inflation data coming up on Wednesday. We kick off earnings season too. JP Morgan results just around the corner. Tomorrow morning, look out for for this full coverage of the jobs report right here on this program with BlackRock's Rick Reeder. Looking forward to catching up with him. Victoria Fernandez across Mark joining us alongside PGIM's Michael Collins. And we'll catch up with the US Secretary of Labour, Julie Su. That conversation just around the corner. From New York City, this was the countdown to the open. This is Bloomberg.